Hi, I'm Sarah McClinchy, Content Marketing Manager here at Surgent, and I'm here with Liz Kolar, founder of Surgent CPA Review. And I'm talking to Liz today about two very important updates that affect the FAR exam. So the first is the equity method. Would you explain to our students how they'll be tested on that?
Absolutely. So I have great news. As part of the FASB's simplification project and their attempt to converge with the International Financial Reporting Standards, the FASB has simplified the accounting for the transition to the equity method. So best way I can explain it is to give you a little example. In the past, when a company, let's say, bought 10% of another company's stock, they would use the cost method. And let's say a year later they bought an additional 15%, so now they own 25%. They technically have to use the equity method. And in this transition, GAAP previously required that companies retroactively apply the equity method to the beginning of the original investment. So even though at 10% they had to use the cost method, they would have to readjust or retroactively apply the equity method to that initial investment and really restate the financials using the new method. So the great news is they've simplified it. Now, under the with this transition approach, companies that eventually achieve the equity method status, they prospectively apply the equity method. So the date they get that level, they just simply use the equity method going forward. They don't have to do any retroactive adjustment, which makes it so much easier for candidates.
It must be so much easier to study for this material now.
Absolutely. We used to call it the step acquisition method, so you don't have to worry about that anymore. And it's rare. I can actually say that the FASB made something easier. It doesn't happen very often.
Rare occurrence.
Very rare. So that's good news number one.
And good news number two is regarding deferring tax.
Yes, so there are deferred tax assets and deferred tax liabilities, and the FASB has simplified the presentation of both on the balance sheet. In the past, we had two classifications. We would net current deferred taxes and non-current deferred taxes. So you could have a net current deferred tax asset, or a net current deferred tax liability, or a non-current deferred tax asset and a non-current deferred tax liability. And determining whether it was classified as current, non-current, very complicated. So they've actually simplified it now. And what the FASB is now asking companies to do is to report all deferred taxes net as non-current. So you don't have to worry about current versus non-current. All deferred taxes are reported as non-current. So companies will net their deferred tax assets and their deferred tax liabilities and have one line item in the non-current section. Now, this is only pertinent to companies that have deferred tax assets in one jurisdiction. So if you, or liabilities in one jurisdiction, if you have deferred taxes in more than the US, let's say, if you have it in other countries, you cannot net them. The good news, this is exactly how IFRS handles it. So if you're accustomed to the IFRS reporting methodology, it's the same now in US GAAP, so they've actually made it a lot easier for candidates.
So a lot easier, but definitely something to note.
You absolutely need to know this. It's eligible for testing starting January 2017. So it's easier for you to actually handle it on the CPA exam, but it's a change, and most likely they're going to test it because it's different.
Yeah.
So if you have any more questions about these updates, please don't hesitate to reach out to us. Best way to find us is on the web at surgentcpareview.com. I encourage you to try one of our free trials. You can access our course and test it out for 3 days free. Just go to our website.
Thanks so much, Liz. And for our students, we've made your lives hopefully a little bit easier.
We look forward to helping you become CPAs. Take care.